Welcome to the Retirement Resource Show, the place to come and live a retirement that is meaningful, fulfilling, and fun. We believe this phase of your life is the best time of your life. It's up to you. And we've got the show to get you there. Here's your host, Bo Henderson.
Here we go. It's that time again. Welcome to the Retirement Resource. And I believe it's time we have a conversation around a few things, but I think we need to go ahead and talk about it. And it's all this talk around the market and the term bear market and a lot of things that come with that. And I couldn't think of a better co-host today than a good friend, guy who's been a money manager, does a lot of things with our community, just a smart guy when we're talking about the tactical how-to of things, right? You know, you hear a lot from me more strategic. Here's how we segment the timeline. Here's how we optimize different areas. Here's how we make sure we're comprehensive. But Zach Scheidt, his specialty is, okay, well, if we have things for long-term growth, we're trying to protect income, what are the actual investments we use? So Zach, welcome to the Retirement Resource. Thanks so much for joining me today.
Well, thanks, Bo. That was a nice introduction. I tried to make sure that you were talking about me and not somebody else in the room.
No pressure. You just got to live up to that introduction. That's the key. Well, what I want to talk about today, because you can imagine you turn on the news and you hear all these words: bear market territory, inflation, interest rates, market volatility. So you're hearing all these, we know they're negative words when it comes to the economy in some context, and it can sound scary, but what I'd like to just have a discussion, and you can kind of take this the way you want to as far as the path. But first, let's just open up about where we are today. And when we're hearing this bear market, what does that really mean?
Yeah, there's a lot to unpack there. And yes, I'm reading the same thing, seeing the same headlines show up, and it really can, sometimes if you let it, the media can get you in such a frenzy that you start thinking you need to do something when maybe you need to step back and actually kind of think about what's actually going on before you jump. So we are in a bear market. A bear market is technically when stocks pull back 20% or more from their high. And there's nothing magical about that 20% number. There's nothing magical about the market or any individual stock pulling back that much. It's just kind of a label, for people to be able to classify things and look back through history and say, okay, there were, 7 bear markets that happened during this period. So what do we expect? And so it's helpful sometimes for historians, but it doesn't mean a whole lot day to day. That likely the investments that you have, especially if you're heavy in stocks and specifically some of the growth stocks, that your account is pulling back, and that's really the important thing, is to kind of understand what is going on with your own investments and where are the risks and how do you manage those, and where are the opportunities, and what is going to what is the best path forward for your wealth. Now, when we talk about some of the scary words that you hear out there, the first thing is I would say inflation. That's the big headline. Everybody's talking about inflation, and it really is. There's good reason why. Inflation is at one of the highest levels that we've seen in probably 40 years. I think that's the latest statistic that I saw, and that just simply means that your money is not going as far. Prices are moving higher at a pretty healthy clip. A lot of this is tied to the energy market. So it's not just the gasoline that you buy, although that's definitely higher. But when energy prices are higher, it means that you have diesel fuel that's higher, which means that it costs more to transport the things to your grocery store or to the department store that you want to shop at, or just buying something on Amazon. It also means that jet fuel is higher. So that means that it costs more to fly somewhere, and also to transport things back and forth. And so high energy costs drive up a lot of other costs that we think are kind of in a different category, but they're really still all connected. And one of the things that I think that we sometimes get carried away with is the fact that just because something has risen sharply over the last few months doesn't mean that we're going to see it continue to raise sharply for months and months and months to come. And in fact, we could see oil prices pull back a good bit if there's any kind of resolution in the war in Ukraine, if drillers start to increase more, or if the economy starts to slow down a little bit and we don't have quite as much demand for energy. So that's the first thing that I would say is, inflation is high. You need to
Right.
protect yourself against it, but it's not the end of the world. There are things that you can do, and we'll keep talking about that later today. There are things that you can do to kind of protect yourself against inflation.
And I want to
Uh,
break in real quick, and that
yeah.
inflation being high, right? It's a correction of where we were for a long time.
hmm
And even the broader conversation of a bear market is that you correct me if I'm wrong, if you have a different idea, Zach, but it's a healthy, normal part of a long-term market growth. So sometimes it's funny is that every time it comes around, it seems like a surprise and it's the end of the world. But really, when you hear me talk about strategy all the time, if we build a strategy the right way and we really navigate the timeline for the things we need when we need them, up or down market shouldn't really change our plan. And it's actually a part of what we have to work with. And I know you'll talk about this. There's hard things that come with these certain cycles, but there's also opportunities. But what do you think about that when I say, you know what? If we built it right, we're just fine. But this is something that's healthy for long-term sustained growth over decades.
Yeah, I agree with you. And I also like what you said about kind of looking back through history and where we are right now. So right now, inflation is at a very high level. But if you'll remember, for the last probably 10 years or so, inflation was extremely low, like very unhealthily low. In fact, we had Chairman Jerome Powell actually talking about how he wanted to bring inflation up. We kept trying to get to that 2% level. Um, there are some interesting ways to think about inflation and what it does that helps and what it does that hurts the economy.
Okay.
On one side, inflation is actually, I don't even want to say this because it sounds preposterous, but inflation is actually good for people and businesses that have a lot of debt. Now, I don't want to reward anybody who has a lot of debt, and who chose maybe to do that, but it can kind of help to reset some things in our economy. Because think about this: if I told you, Bo, right now that I've got $1 million in debt, I don't. But let's just say I said, "Hey, Bo, I'm Zach. You've never met me before, and I've got $1 million in debt." What would your initial reaction be?
Most likely, wow, we're going to create a lot of income to deal with this debt, right?
Yep, yep. Yeah, that makes sense. So then what if I said, yeah, so I've got $1 million in debt and I just sold a company for $7 million. I've got a beach house that's worth $4 million. I don't. Uh, I've got a jet that's worth $7 million, and right now I've got $1 million in debt. What do you think I should do? That changes the picture, right?
Right.
All of a sudden, the $1 million in debt looks a little bit different when you see that I've got assets, I've got cash flow, I've got other things that offset that $1 million. Now, inflation can have a similar effect on businesses and people who have a significant amount of debt, because as inflation drives other things higher, the value of homes that they own, the inflation drives wages higher, inflation drives other things higher. It becomes easier and easier for people and businesses to pay off debt. So again, I'm not saying that don't want to color anything with rose-colored glasses, but you see why a certain amount of inflation can actually be healthy for our government, for the economy, and for individuals. Because if you are able to raise your income and you're able to raise your assets, and the other side of the equation, sometimes those positives can actually offset, or even more than offset, the bad side of inflation. So I don't want to hang on that and spend too much time on that,
Sure.
but we do know that inflation has certain benefits in the overall economy. And for a while, we were trying to get inflation higher. Got to be careful what you wish for, because now inflation is exceptionally high. And I can say with a good bit of confidence that it will moderate in time. We'll have other conversations a year from now, 2 years from now, 3 years from now, where we have different problems, different solutions, different outcomes in the market and the economy that we're trading in right now. So that's inflation. I guess the second real big issue that we hear in the media right now, and the terms that get thrown around, are the higher interest rates. The interest rates are rising. The Federal Open Market Committee Chairman Jerome Powell has been on TV, in the news everywhere, saying that he's increasing the interest rates. So why would the Fed try to increase interest rates, and what does that exactly mean for our economy? Well, when you increase interest rates, it does a couple things. One of the main things that it does is it gives savers a better alternative for what to do with their money. So if interest rates are very, very low, you probably want to spend your money, right? Because there's really no benefit in keeping it set aside if interest rates are low and you can't generate a return on your money. But when interest rates rise, it creates a little bit more of an incentive for people, and again, businesses, to take their money and say, I'm going to put it aside for right now because I'm earning 3% or I'm earning 4% or whatever that rate is for the specific savings that I'm using. And that reduces the amount of demand. It reduces what people are spending in the market. Why is that important? Well, because when you have a lot of money chasing after goods and services and people are willing to spend more and more and more, then it drives the price higher. But if you have less money available to spend, then there won't be quite as many people trying to spend that money, and it'll help to ease prices. You know, to put this as an example, when there's a lot of money available, and let's say that I wanted to take my family on a trip to Disney. If I had a good bit of money in the bank and I told the kids, hey, we're going to Disney, you know, get your Minnie Mouse ears, all that stuff, you better believe if they raise prices, I'm still going to go because I'm a dad. I told my kids we were going to go to Disney. If I have the money available, I'm going to follow through on that promise. However, if I don't have quite as much money available and I told them we were going to go to Disney and now I literally can't afford it,
right,
I might have to go to my kids and say, hey, listen, we're going to wait for a year to do that. Meanwhile, I'm going to take you to the water park down the street and we're going to get season passes and blah, blah, blah. I'll figure something else out. But I'm not going to spend that money just because I literally can't afford it and I want to take good care of my finances and my family. So that's kind of the deal with interest rates. It pulls some of the money out of the economy, and it helps to reduce that spending. So it helps to reduce the inflation that we have. That's not a really scary thing, but there are ripple effects in the economy. When you raise interest rates, it causes a lot of things to change. One of the things is that it causes growth stocks to trade lower. Because investors realize, hey, I can put money into a CD or I can put money into a bank account and I can earn a decent amount of return here. I don't have to take a lot of risk with a growth stock that might trade lower, that might disappoint at some point. And so those alternatives, as those alternative shifts, investors move money out of certain areas and into other areas, which is why we've seen, especially the really speculative growth stocks, pull back quite a bit. I do think that that's something that we could continue to see. So I wouldn't advise right now just going headlong into some of these growth stocks. But I do think also that we've seen enough damage in certain areas of the market that there are a lot of opportunities, because we've already seen the pain that's supposed to come with higher interest rates. And go ahead.
Let's talk about that for a minute. So we talk about an opportunity. So when the market's beat up, and it's certainly beat up to an extent. Could it be beat up more? It could. We both know that. Where is the opportunity? Meaning maybe we don't shift out of stocks, right? Because that's that's the thing that's beat up. But I think especially for some of my people still working, hey, let's be contributing. Let's be dollar cost averaging into this. Even if it's going down, we're going to buy it up cheaper. Who cares if it drops? What I'm more concerned with is the lump sum that you need for asset over the next few years. But so let's talk a little bit about that, about the opportunities you see when the market, or maybe we go the other side to after tax accounts, that, hey, maybe we can now have some more flexibility because the gains are down to a reasonable level.
Yeah, there's a lot to unpack there. So first off, I want to ask you a question, Bo. We talk about a bear market and stocks trading lower and all that, and a lot of us, who have been through this several times, start to talk about this is a great time to be buying. I don't know if you've got the same experience that I've got as I'm talking to people, but when I say that and I say, hey, listen, don't panic. This is actually a time to buy. There's a response that I often get. I want to hear what you typically hear from your people.
Yeah, it really depends on a lot of response, and I'll give you a good example of that. and they wouldn't mind me sharing this story. I've had 2 calls now over the last probably 6 weeks, and the calls go like this: between my match and what I'm contributing, I'm putting $1,000 a month in my employer plan.
Hmm.
I'm really nervous because I'm putting that much in, and it's not going anywhere. If anything, it's dropped some.
Hmm.
Um, in the context of this conversation, this person's retirement plan is set up. Their income for the first decade of their retirement's already secure and set up properly.
Okay.
So the conversation is, I feel like what I should do is stop contributing because I'm not making any progress.
Mm-hmm.
And once we talk through it, my reply back, because you're in the position to save that money, we're dollar cost averaging in when the market's going down, which is actually a good thing. Doesn't necessarily
Hmm.
feel like it emotionally, but if we do what human nature tells us to do, the market recovers, everything's high and pretty again, and we invest, we missed all the upside. So
Yeah,
I have a lot of
absolutely.
similar conversations to that. I'm scared. Maybe I want to stop. Maybe I want to pull out. And yeah, you have to have some conversations. Is that the mathematical answer? Is that
Sure.
the best thing for your long-term plan, or is this emotion?
I love that, and I think you're doing a great job of kind of explaining that whole process. It's funny that the market is one of the few places that people actually hate buying on sale. You know,
Right.
I'm thinking about my son Caleb he's got a Lego collection, and a lot of times when he has extra spending money, he likes to go, buy a different Lego set or something. What
Right.
if I told him like, okay, Caleb, you can buy 2 Lego sets with your allowance today, and then tomorrow I said you can buy 3 Lego sets with your allowance, and it got better and better every time he had more money. Every time he had the same amount of allowance, he could buy more Legos. I mean, wouldn't he be jumping up and down excited about that?
Or
And,
no,
and
Dad, I want to wait till I can just buy one with my allowance. Right.
right. No, I'm gonna exactly. We don't get that response, and I think that's it's just the way it's. I guess it's human nature because we see the value of what we've already bought trading lower, and so we think that we don't want to get that good deal on whatever it is that we're buying on the stocks that we're buying. But you're right, dollar cost averaging actually benefits you if you're putting $1,000 to work every single month. And this month you're getting 75 shares instead of 70 that you got last month.
Mhm.
I mean, that's great. That's wonderful. But this goes back to, in a bear market, you really have to use your head and not your heart. Or if you're use your plan and not what is driving your emotions. And I think that's an area that a lot of people wind up losing a ton of money, because they actually make emotional decisions, and it feels bad because you see your allowance uh, or what you spent your previous allowance moving lower. Now, you did ask a question about, what would I consider buying, and I think this kind of gets to a little bit of the difference between you and I as far as sometimes how we look at the market, and I think there's benefits on both sides. I know that um, you may be a little bit of a broader investor, whereas I like to look at the individual stocks or the
Mhm.
individual sectors where there's opportunity, still being diversified into different areas of the market, so that if one area falls off, you still have another area that's going to continue to do well. But a few of the areas that I'm looking at that have the most potential right now are a lot of things that you can just touch and feel. So think about the energy market. I do think that oil stocks, natural gas stocks, and a lot of the traditional energy stocks actually have a lot farther to go. And
Okay.
you might think that's funny that I would say that, because I already talked about oil prices pulling back. But if you look at some of the charts and some of the statistics and the data behind this, as oil prices have moved higher, let's say that oil moved from right here. Let's see if I'm on the camera, from right here to right here. That's how much oil moved. But the oil stocks themselves have only gone up this much. They've only maybe made up half of that difference. And the reason is because oil is higher right now because there's something big going on in the market because of Ukraine, because of Russia, because of these spiking prices and spiking demand. Whereas oil stocks are not up as much, because investors are like, I am not sure that I really want to put my money into those stocks because remember 2 years ago these stocks were out of favor. So
Right.
I'm just not sure if I really want to believe it this time. And I've seen this so many times. I saw it after the dot-com crash. I saw it after the housing market crash. I saw it after the financial crisis. The stocks that got hit or that were just dead for a while, they take a long time for investors to really get confident in those stocks again. And so those stocks can actually have long-term, slow and steady bull markets, which I love, by the way. I love a slow and steady bull market instead of a, shoot straight up and then come straight back down kind of a market. And I think energy stocks are kind of in that area where they're maybe in the second or third or fourth inning of what will be a longer term bull market. Again, things that you can touch and feel. The housing market, this is a little bit of a controversial call, but I think that housing stocks are actually still really good investments.
Okay.
And that's because the demand for new homes is still very, very high. Yes, prices have been moving higher, and that's made it more difficult for buyers to find affordable homes. But what does that mean? That if buyers are having a hard time finding affordable homes, it means we need more homes. It means there are people out there that want to buy, they just can't buy. So if you're a home builder and you're able to put more homes out onto the market, you're able to get these things out there, open the front door, get people in, you're selling every single home that you can build as fast as you can build it. And so that's actually good news for home builders. Now, we may not see prices move sharply higher the same way that we did over the last 2, 3, 4 years,
Right.
but prices are not going to go down, or at least not down substantially, because there's still a lot of demand. So again, those are areas that you can touch and feel. And then even some retailers, like the really good retailers that make good, solid products that people want to buy, the Costco's of the world, that sell things at a good value, and they know what they're doing, and they continue to generate profits year after year. Again, those are things that you can touch and feel, but those prices, the prices for those stocks, I expect to trade higher, especially as some of our supply chain issues kind of improve. Merchandise is able to be moved in. We get a better feeling for what customers want to buy this summer heading into the holiday season. Some of those should do very, very well. So again, I really like the things you could touch and feel right now. I'm not quite as excited about some of the technology, the artificial intelligence. Some of those names have been overbought. They got way up. And now they're still kind of in the process of coming back to earth. So I don't know if that helps or not, but I think those are some really important areas to look at tactically in today's market.
And it makes logical sense, right? There's certain things that are going to be used no matter what.
Mm-hmm.
And there's other things that are just, like you said, with the Disney World, Disneyland example, there's other things that are discretionary.
Yeah.
Right. And I can see that logically in how we invest. Being tactical is, hey, if we're going into this market with these issues, that maybe that's a little shift we make is, what are people going to be using and doing regardless of the market? All right.
Yep.
So good. So we're talking about these issues. We talked about all this, and I know you had a little bit, we talked about emotions a little bit, right? We can't, the worst mistakes happen when in environments like this, we make the wrong emotional decision. Right. So where do we go next? What do we do? So we have our, I hope today, a lot of what we've talked about so far is just, we're hearing these things, inflation, interest rate, bear markets. And I think just talking through it a little bit, sometimes when you talk through it, it's not just this negative word that creates a lot of bad energy and a lot of bad feelings. So where do we go? So how do we turn, what do we say? I want to do it backwards. How do we turn lemons into lemonade? There you go.
Yep, exactly. When life throws you a bear market, make lemonade or something like that.
There you go.
So I would say that the first thing that I'm telling people right now is that fundamentals matter. And I'm excited about this because when I say fundamentals, I'm talking about like, how much does a company earn? How much debt do they have? Looking at a company and seeing like, are they a profitable company? That matters now. And I love that because we've spent so much time, and it frustrates me, but so much time looking at concept stocks of, oh, this company has the greatest technology in the world. Yeah, well, they're losing a whole bunch of money. Oh, I know, but they're still a great technology company. We're back to a place.
We're back where fundamental analysis actually is relevant. That is kind of exciting, right? You can
It
actually,
is.
what's the company worth and is it selling for less?
Right.
Right.
And so the second thing I would say is that price matters. So fundamentals matter, price matters. What are we paying for this stock? Bo, if I were going to sell you my business, whatever my business is, what would the first thing that you would ask if I came to you and said, "Hey, I'd love to sell you my business"?
What's it worth from
Yeah.
multiple, revenue, whatever metric we need to talk about.
Right. So how much money are you making? How much money is coming in the door? How sticky is that money? Are your customers going to go away if you sell me this business?
Right.
And so we would come up with a price based on what's going on with my business. And as investors, we need to do the same thing. If we look at how much are we paying for every dollar of earnings this company generates? And the cool thing is you can find that information on any free website, Yahoo Finance, Google Finance. There's a website I really love called FinViz, FINVIZ.com. It's got some ads, but the thing is that you can get all kind of great data about every single stock on that website.
Right.
And what I like to look at is the PE ratio, and that is price earnings ratio. Price, how much am I paying for the stock? Earnings, how much in profit does this company generate per share? So for every share of Amazon, how much profit is Amazon generating?
Right.
And then what we look at is how much am I paying for every dollar of earnings? That's what the PE ratio tells you. It's really simple. So don't get overwhelmed by some of the data that you see and some of the crazy numbers that people throw around. Just how much am I paying for every dollar of profit? And if you're able to pay $10, $15, maybe $20 per dollar of income that a company generates every year, that's a whole lot better than the 30, 40, 50, 60 and more that we saw before. Okay. So I like to look at that and specifically at that versus other competitors. So if you're looking at an oil company, look at 5 or 6 oil companies and see which one has the lowest PE. How are you getting the most profit for every dollar that you spend? That's not the only thing that you look at, but it's one of the most important things that you look at. So fundamentals matter, price matters. How much are you paying for your profits? Mm-hmm. And then the third thing that I would say is income matters. And Bo, I've always had a soft spot in my heart for companies that pay their shareholders dividends. So for many, many companies, if you buy shares of stock, you get a piece of their profit every single quarter. They used to mail you a check. You'd open the mailbox and actually take the check to the bank and cash it. Now that money typically gets invested directly into your brokerage account. But if you buy shares of Home Depot, Coca-Cola, Lowe's, I could name dozens, hundreds of companies that pay great, ExxonMobil, Chevron, whatever. You can just keep going down the list. The great companies that generate great profits pay good dividends. And so income matters. And if you're able to collect that income, then you can decide whether you want that income to help cover your day-to-day expenses or whether you want to reinvest that income. So going back to that question that I asked you, and this might show kind of the difference in some of the different people and the different perspectives that we have, depending on who we're talking to and what stage of life they're in. But when I talk about buying shares of stock in a bear market, the big pushback that I get from a lot of people is, with what? How am I going to buy new shares? We're in a bear market. My money's down. I've already invested all my money. Now it's down. How am I going to buy new shares?
I don't have any cash. I can't buy even the cheap stocks. Got it.
Right. And that is so frustrating. And I get it. And it makes me sad because you shouldn't find yourself in that position. But many people have. And if you do find yourself in that position, I'm not here to judge. Like that. Right. I hope you and I never step into that category in somebody's mind. We are here to help. And so if you find yourself in a spot where you tripped and you fell on your face, that's okay. Here, grab my hand. Let's stand up. Let's make some wise decisions and figure out how to walk forward. But if you are in a spot where you don't have a whole lot of cash to invest, I think that's all the more reason to focus on income, because as you generate more income, especially from these dividend stocks, you're able to then take that income and you can buy more shares. Like you were talking about with the dollar cost averaging, you can buy more shares. And the lower the price of the stock, the better it is for you, because that income then can be used to buy more shares. One thing I love about that, just real quick, in today's market, because of some of the new brokerages like Robinhood and some of these guys, many brokerages allow you to even buy fractional shares. So maybe you don't have enough income to buy a whole share of ExxonMobil or Apple or something like that, but you could even buy a tenth of a share, and that still means that you're going to get more dividends the next time the company pays dividends, and then you buy another tenth of a share, and that slowly starts to move a little bit bigger and bigger each time they pay a dividend. And before you know it, that compound interest, that compound income actually helps to grow your wealth and get you back to a really good place in the market.
Now, so dividends, definitely dividend stocks. And we talk about retirement, Zach. I'm glad you brought up income, because it's an income game, or it's a cash flow game, right?
Mm-hmm.
We can, and in the context of a lot of people here, they're preparing to transition into the retirement, or they're already there. And what I mean by cash flow game is we have certain expenses for either necessity and hopefully for your lifestyle that you want to live. And we have to figure out how to take our puzzle pieces and create income that's hopefully exceeds those expenses, right? So that's
Mm-hmm.
really the game, because if we have that, it's just like if we have a job during our working careers where our paycheck's bigger than our expenses, works just fine. So when we focus on that, that's one of the biggest parts of the equation that we can deal. So we talked about dividend stocks, which is great. You can get little soldiers put into your account that keep working for you, buying more soldiers, right?
Yep.
That's what came to me. What else? Any other strategies we could do in context of this conversation today for income?
Yeah, absolutely. So another strategy that I really like, and I used this one when I was at the hedge fund. My boss and mentor Bill taught it to me, and he's kind of one of the pioneers who first started doing this.
Right.
Is to sell what's known as covered calls against stock that you already own. Now that sounds confusing, and it might. Don't tune out. don't. Let me explain really quick, and I think you'll understand and really appreciate this concept. So let's say that you own 100 shares of stock, and it's trading at $50 per share. You could sell a call contract against your shares. So basically what you're doing is you're entering an agreement, and let's say that you wanted to sell a call contract that requires you to sell your shares at $55. So the stock is trading at 50 right now. You can sell a call contract that enters you into an agreement that you're willing to sell your shares at $55.
Okay.
And you get paid for that agreement. You get paid right now for that agreement. And it all depends on where the market is trading and which specific call contract you sell. But it generates income from the shares of stock that you already own. And then a couple things can happen from there. If the stock trades above 55, then you're required to stick with your agreement, and you have to sell your shares at $55.
Right.
So if the stock went crazy and went up to 70 or 80, you give up some of your upside, but you still get to keep the income that you received for entering that agreement. So that's income in the bank. And you still get to sell your shares at your agreed upon price. And remember, when you first entered that agreement, you were happy with the $55. So that's a way, it's a way to, to actually get extra income and to make an agreement that you were perfectly fine with. On the other hand, if the stock doesn't trade back above 55, then you still get to keep the income. You're still holding the same stock that you were before. And once that call contract expires, these have a limited amount of time, then you can go in and you can do the same thing again. You can sell another call contract. So it's one of the ways that we at the hedge fund used to make extra income from the stocks that we held in our clients' account. And I watched my boss and mentor Bill do that for years and years and years in his own personal account, generating extra income from some of his favorite stocks. So if you have a stock that maybe doesn't pay a dividend, and you still want to generate extra income so that you can buy stocks and take advantage of the lower prices that the current bear market is giving us, that's one way of doing it. It's just kind of a creative way of generating extra income from your stocks that you've got.
And when you start getting into these kind of strategies we're shifting into, it makes perfect sense, right? If I buy a stock for something and I'm happy, if it went from 50 to 55, I'm okay with that. Plus I get a little bonus yeah, there's a little FOMO, right? Fear of missing out if it drives
Mhm.
to the roof. But I was already okay with that. So as we get into these strategies, it's really, to me, it seems that's where you have to have some discipline and some serious structure, right? This kind of
Sure.
strategy, I don't see any room for emotion, right? This
No,
does
no.
this, we do this, but I could see there's rules there, and there's contractual specifics there that I could see how you could make this profitable regardless. So no,
Yeah.
I like it. I like it. It's just
Yep,
different.
yep.
Okay, so
It's
that's
it's like my
covered
mom
cost.
always used to say, "There's no such thing as a free lunch." So you're giving up something to
Right,
get something else. You're getting the income right now, and you're giving up some of that fear of missing out. If the stock goes to 100.
right.
But again, like you say, it's a disciplined approach to generating reliable income over and over and over.
Okay, so that we're betting on the upside, right? The covered calls. The call would
Hmm.
be, I'm agreeing to sell it if it increases above a certain amount. And I know we've worked on a strategy and talked through a strategy, and I've interviewed you on a strategy. It's kind of on the other side, right? That's
Yeah,
yeah.
it's very similar, but it starts from the position of I'm interested in a stock instead of I already own a stock.
Okay.
And yeah, so that's the third way that I love to generate income. And this is a strategy called selling profitable puts.
Okay.
So a put contract is a similar agreement that we can enter into the market. Um, and what you do when you sell a put contract, you're agreeing to buy shares of a stock. So
Okay.
let's say, Bo, you and I are watching this stock. We really like it. It's trading at maybe it's trading at $52. And I say, Bo, I would love to buy this stock if I could just get it for $50. It's just a
Right.
little higher than I want to pay for it right now.
Okay.
Well, we could sell a put contract with a $50 agreement price. And what that means is I'm selling my agreement. I'm agreeing to buy shares at 50, and I'm getting paid for that agreement to buy shares at 50. So fast forward a month. Let's say that we sold a put contract that expires in a month. We'll fast forward to next month, and if the stock is trading at 55, I
Right.
will not buy the stock because I'm not because the person who has the agreement with me doesn't want to sell it to me at 50 because they could sell it at 55. So
Right. Got it.
what happens is that put contract expires. That sounds bad, but guess what? We got paid
You
to
got
enter
paid.
the agreement,
Right.
and we get to keep that payment no matter what. So it's a really good scenario where you can get paid to enter an agreement. On the other hand, let's say that the stock pulled back to $48.
Mhm.
Well, this is a stock we were watching, right? It was at 52 when we entered the agreement. Now the stock traded back down to 48, and I will be required to enter that agreement or to fulfill that agreement. So now I have to buy it at 50 because I said I would buy it at 50. It's better than what it was when it was at 52, but maybe it's not quite as good as I could buy it at 48 right now. But remember, Bo, we got paid to enter that agreement. Maybe we got paid $2 to enter the agreement. So we have $2 in the bank. We're buying a stock that's maybe $2 more expensive than what we would have otherwise.
Right.
But still, it's a great way to generate that income. If the stock moves higher, we get to keep the income. If the stock moves lower, we wind up buying shares at a price that we already said we were perfectly fine with.
Right.
Either way, we get money in the bank that we get to keep no matter what.
So the
So
key,
it's
it's a good stock you'd want to own at a price already, and that's the worst
right.
case, is that you
Yep.
own it at that price. Okay, I got it.
Yep. Yep.
So a lot of strategies, and like I talked, I think when me and Zach get together and we work on a lot of things together, I feel like it's strategic and tactical coming together. Which I think when you have both, that's really the next level, right? When you have the right
Hmm.
strategy and they have the right tactical components within your growth portfolio, or even to Zach's point, within this specific market, what are the areas that there's opportunity, right? We're getting very
Sure.
specific and very tactical. So I love that. And one of the things, Zach, if you don't mind, I know this wasn't the point for us to talk about a product or anything, but I have interviewed Zach and we've talked through a system that's really similar to that last profitable put system, right?
Hmm.
Where what that system is it's Zach as a money manager. What he's done is he actually creates the portfolios with, because a lot of times it says that sounds like a great strategy, but how do you do it?
Hmm.
And and you can fill in any blanks I'll leave out, Zach, but if it's something you say, I'm interested in that kind of strategy, but I don't know where to start. I don't know where to set up my brokerage account. I don't know what stocks to look at. That's exactly what you work on, and you watch it and you build it and you help people with that. And so you could still be a do-it-yourselfer, but do it with some guidance maybe. So Zach, anything to
Yeah.
add to that?
No, I would just say, I mean, you've got it right. It's a special service that kind of does two things. It goes through the education at the very beginning and shows you how to set everything up and explains all the details of that particular type of transaction. But then it's a portfolio of a diversified group of trades that follow that exact strategy. So then if you'd like to, you could follow those along in your account and do each trade as we recommend it. Or if you want to pick and choose kind of, oh yeah, that one sounds great, I really like that idea. I'm not quite as interested in that stock, I don't really want to do that one. You can pick and choose which one makes the most sense to you. But it's a great, I think it's a great resource to show you how to do it, and then to actually give you the fish. So what is that old saying? If you teach a man to fish, you feed him for a lifetime. So I want to teach you how to fish and feed you for a lifetime, but I'm also serving up some side dishes on the side, so you can actually eat while you're learning too.
And full disclosure, I don't just bring that up. I actually participate with Zach's strategy and his model and his actual picks and where they go. So full disclosure there. But Zach, appreciate so much. I thank you so much about I think some of the just talking through when we have conversations about things, sometimes it diffuses some of that energy of just right now. And it's what news does. News is used a lot of times to click something or to get people to pay attention a little longer. And it can be
so they can sell the advertisements.
Exactly. So there can be, so I think sometimes us just having conversations about money. And I think anytime we have something come inside of us that doesn't feel good, or I'm scared, I'm anxious, I'm nervous, have a conversation about it. Usually talking about it, clarity, that's the antidote to those feelings of anxiety, fear, and things like that. So that's my psychological input for the afternoon. Right.
I like it. I'll just add on to that real quick. Kind of how I got into some of the businesses that I'm in right now, where I get to write about investments and all that, started back when I was at the hedge fund, and I wrote a little blurb about every stock or every position that I took. And it wasn't for anybody else. It was literally for me. As I thought through things, if I wrote out, this is why I like it, this is where the risks are, this is what I'm expecting, this is what happens if I don't get what I expect. Just by having that plan kind of written out, it made me a better investor. And then eventually I realized, hey, other people might be able to profit from this as well. But I would just say, if you're listening to this or watching us right now, that might be a really good tool, especially for a bear market. Just write out whatever it is that you're expecting to do, or discuss it with somebody that you have regular conversations with, and just by doing that process, you'll think through things a lot more clearly. Sorry if I jumped in.
No. I'm just going to say it again because I know this to be true. I've done this long enough and enough times. Conversations and clarity are the antidote for fear, anxiety, doubt, and worry. So, and this is so what I want to sum this up, Zach. So you're telling me that this isn't necessarily different this time. This isn't going to last forever. It will turn and the cycles will come the other way. It's because those are the kinds of things I think it feels like when these cycles shift and go to places we're seeing today. So if we have any good news, are you with me on that? A year from now, we're talking about different issues in a different cycle, and the hard things about it and the opportunities. It's part of it. And it's all part of normal, healthy, long-term growth over time.
Yep. This too shall pass. I'm not going to Pollyanna all of this, because it's challenging to walk through. I know it. I'm walking through this alongside you. I've got my money in the market as well. But this too shall pass. We've been through seasons like this. We see the highs, we see the lows, we see the contractions in the economy, we see the job market strong, we see the job market weak. We will get through this. And like you said, I think the conversation is a big part of that. Being able to talk through things with people, being able to understand that you're not alone if you're dealing with some challenges here. and then to really take that emotion out of it and make that wise decision, whatever it is, with the stocks that you're invested in, with your decisions on how you're going to be spending your retirement, um, with thoughts about what your long-term strategy is going to be. Don't make that decision emotionally. You don't make it emotionally when things are great either. You don't
Right.
decide we're going to buy a yacht because the money's coming in easy. You also don't decide that you're going to eat pork and beans for the rest of your life because this is a challenging period right now.
All right, Zach, I'm gonna do something. I'm gonna shift.
Oh.
This is my serious camera. I got something serious to say when I come here. But all this to say that we've been, and Zach, thank you so much, because you're a person I can have certain conversations with that I can't with other people because of your background and knowledge and our friendship and just us knowing each other really well. One thing, make no mistake, we talked about this too shall pass, right? And you're right. But people are hurt that aren't prepared. So if anything, the scary stuff, let's make this a call to action to be proactive. Because if we're proactive and we're set up with a strategy or a plan or a retirement plan, whether the market's up or down, your plan's still intact. So let's use this as a call to not be reactive, not address it after we felt the pain, not address it after I wanted to retire this year and my portfolio is down 20%. Now I can't. Let's shift. Let's just use this as our wake up call to shift to, I'm going to be a proactive participant because this is my money. This is my family. This is my future. And I'm going to get a much better result and be in a much better position when life inevitably throws us these cycles, and it always will.
So, I like that.
End rant. There you go. All right, Zach, so if you'll bear with me, I've got one last thing I'd like to do. We have a segment called Best and Worst, and I'm going to go to the clip, and I'm going to plant a seed with you.
Okay.
Think about something that either was a good, something that might inspire us, something that you've come across, seen. It could be your own experience, it could be somebody you know, or something that was a really bad situation, but that we could probably learn from. So we'll do best and worst in just about 13 seconds. Man, I love the energy of that segue, right? It's like lightning crackling. Good. Okay, would you come up with something? Gave you 13 seconds. It better be.
It better be really, really good. No, I would say on the best side, I would look back at my boss and mentor, Bill. Bill actually had a specific position in his personal account that wound up getting in trouble during a bear market that was a lot like this one. But because he used that strategy that I was telling you about to sell covered calls, he sold calls against his stock or with his stock over and over and over to where he made enough income from selling those call contracts that it completely offset, from what I could tell, it completely offset and more the decline in that stock during the bear market. So it was an inspiration to me just to kind of see how he was able to handle strategically and tactically, as you said, that bear market. But I've got a worse too. I wanted to share. Can I do that as well?
Both. Okay. So there's a lesson. Sometimes you have to be open to new ideas, and I know your mentor. We've talked about some of his stories, new ideas, and creatively navigating a situation. Okay, that's a good lesson.
Yep. Yeah, and not using his emotions and panicking and so on.
Right.
So the worst would be a guy who used his emotions. This is a good friend of mine. I won't use his real name. We'll call him George.
It's not a friend of mine, is it?
Maybe.
Just making sure. I got this friend.
Okay, yeah, no. This actually was a friend of mine. We'll call him George. But he had a stock that was up a whole lot, kind of like some of those Pelotons and Zooms and everything that went up like crazy during the post-COVID crisis. And he decided that he didn't want to sell because if he sold, he would have a huge amount of tax gains that he'd have to pay taxes on. And we talked about it, and he was like, "Yeah, I'm so worried that this is going to pull back, but I really don't want to sell now because if I sell now, then I'll have to pay big taxes on it. I'm going to wait until we're past the 1 year period, and then I can pay long-term capital gains instead of short-term." And he told me, he's like, I think it could pull back. I'm scared it's going to pull back. It might pull back. It's way too high. It's going to pull back. And then we watched it, and he said, yeah, it's pulling back. Yeah, it's moving lower. Yeah, it's moving lower. Well, the good news is, Bo, my friend George never had to pay any taxes on this stock. The bad news is because he didn't sell it until it was already down from where he bought it. And so
Right.
that huge gain that he had gotten really, really quickly completely evaporated because he was trying to avoid paying taxes. So that's the whole penny wise, pound foolish kind of a thing. And it was one of those things where he really did let his emotions get in front of him from
Right.
making a wise, tactical decision.
Right. I mean, and that reminds me of kind of a business school type of adage is just because something is working doesn't mean your investment in it's going to turn out better by sticking in there, right? Or staying in there
Yeah.
longer.
Yep. And sometimes letting what am I trying to say? The details or the numbers
Hmm.
override what you really know conceptually to be true. This thing is overvalued, but I don't want to,
Right.
have to pay the extra 15 or 20% in taxes. So, looking at those numbers in the wrong context.
Which, if we did the math on that, he would have locked in a lot more money, right? Had he
Yeah,
just paid.
exactly.
So
Yes.
all that
Yep.
to say, I do hope, Zach, again, I'm hoping if we accomplish what I hope to today, just a little bit of conversation, maybe release a little anxiety, maybe there's some hope. And the hope is that all the stuff out there, the interest rates, the inflation, the market, I have no control. Zach has no control. You have no control over that. But we can control our strategy. We can control the controllables. And the people that do that, when these things come up, they're in the best position possibly to navigate them. So
Hmm.
that's my hope, is that you take hope from that. And we're here to support you. Zach's on the team. Anything you need, anything you want to hear, if it's an expert about dating in retirement, if it's about eating healthy in retirement, it doesn't always have to be retirement investment strategies. Let us know. This show is for you. And I look forward to seeing you soon next week, same time, same place, right here on the Retirement Resource. Thanks, Zach.
Thanks, Bo.